More Canadians than ever are taking on so-called risky mortgages, and this coincides with some of the highest interest rates that we have seen in the past 20 years. So, are Canadians digging themselves their own grave? Or is this just a little bit of a stopgap to tidy themselves through a little bit of a tough time in the real estate and overall Canadian economy? We're going to talk a little bit about Canadian private lending and where it sits in the actual landscape of mortgages. Are they risky? What's happening right now, and what should you expect going forward into 2024 when it comes to private mortgage lending? But before we do that, I'd like to ask you one favor. Just go ahead and hit that subscribe button and hit like. If you're loving this content, share it out. It's the one way that we're able to affect more families and provide them with an opportunity to create wealth and avoid those crazy high costs that they might be paying otherwise if they're listening to the banks. Private mortgage lending has a significant presence in the actual economy, and it's something that most people don't even know about. A lot of people think it's the ugly underbelly of mortgages in Canada, but the reality is it's actually played a very vital role for the past number of decades. And in most situations, these companies have lent out billions of dollars of money in a situation that makes sense for most Canadians. So a private mortgage company can come in a lot of different shapes and flavors. For today's conversation, we're talking about non-institutional lending, often called mortgage investment corporations. And most of these companies have been in operation for a long time. They're professionally run, professionally audited, and they use money that comes from investors that are pooled together to provide people with an opportunity for lending that is what we call equity-based lending. Now, equity-based lending is lending that typically doesn't require proof of income or minimal proof of income. For many people, there is a little bit of a tightrope to walk when it comes to private lending because there's concerns over the high costs, whether it comes down to fees or interest rates. But for many others, they realize that this fills a very important gap in the Canadian lending landscape, especially for the past 10 years as mortgage lending has become stricter and stricter and stricter. Now, it's important to note out that most private lenders can only loan up to a maximum of 80% of the property value. Typically, however, we see most private lenders actually hoping to keep their portfolios under 70% of a property's overall value. And this is because they want to continue to keep equity in the property for the sake of ensuring that if the actual borrower defaults on the loan, that they can continue to make sure that they can recapture the equity from the property and not walk away underwater. Now, many different portfolios are different. Many MICs have a different amount of risk tolerance, but in many circumstances, we've seen that a lot of these lenders are hoping to keep their portfolios under 65% for reasons, as we just touched on. They're hoping to keep their actual portfolios very strong and clean. In what we consider to be a major economic shift in the real estate and the overall income market for Canadians, we expect private lenders to be taking on a much more important role over the overall real estate landscape. And it's probably no surprise to hear that most private lenders are busier than ever, especially with some Canadians losing jobs, the cost of living so expensive, and in many circumstances, the restrictions that have been placed on Canadian borrowers for the better part of the last couple of years. Now, in talking to a couple of different private lenders, we've found out that there has been more demand than ever, and most of these actual private lenders are looking for ways to make sure to strengthen their portfolio while providing a great opportunity for people to put themselves into a better position to qualify back at a federally regulated institution. With over 3.4 million actual mortgage renewals expected to be coming up from many banks over the next couple of years, and a lot of people who have had changes in their financial situation, there are a lot of folks expected who are not going to be able to actually renew or continue to keep their payments at their existing banks. And for that reason, we expect the popularity of mortgage investment corporations to fill a larger and larger gap. As an example, in circumstances where people who have lost jobs, lost partners, have a lower amount of income than when expected, or in a situation that's outside of those parameters, a private mortgage lender can typically provide someone with the ability to borrow money, whether it be $20, $50, $100, $150,000 for a period of 1, 2, or in some cases 3 years or more, and actually be able to make sure that they can ensure their payments are being made while keeping their home and setting themselves up for success in the future. Why do people even go to a private lender, and where does this even come out? Now, the reality of private lending is because it's an unregulated space, it comes in so many different shapes, sizes, and flavors. It could be a small one-person shop all the way up to a company that has multiple different people working for them and has funds all across the country. In many different circumstances, as a mortgage broker, we are working with companies that have a proven history of both being able to service the customer and the client and properly underwrite the actual location. There are some circumstances, unfortunately, where some private lenders are one-on-one and they're lending money without the level of experience that we're hoping for. And in many situations, those are the ones that are making the news, which is realistically 1% or less of the overall amount of private lending. So when it comes to actually getting a private mortgage, we always recommend that the client who's seeking the private loan does some due diligence to make sure that that mortgage broker has the experience to know where to place the loan, isn't overcharging different fees, interest rates, and is able to provide them with the information of who this mortgage investment corporation is and what their history is when they're taking on that mortgage. Now, from a value proposition perspective, this also provides people with the opportunity to overcome obstacles. As we mentioned previously, there are a lot of Canadians who are stuck in between a rock and a hard place, whether that's because of a job change, immigrating from a different country, partway through building a home and the costs have risen. There are so many different reasons why private lenders fill a perfect gap. And in most circumstances, we find after talking to some of the largest private lenders that the average timeline that a private mortgage is on the books is actually 2.5 years. And in most circumstances, the individual who owns the property or has the mortgage is often able to refinance that mortgage and get it into a conventional loan when working aside a broker who can help them make that transition. So in most of these circumstances, they are good stories. In some of the odd situations where they're not positive stories are circumstances where people end up just selling their properties, paying out all the mortgages, and walking away altogether. But again, those are few and far between. However, those are the ones that are often published in the news. Some of the trends that we've seen over the better part of the last couple of years for private lending include people who purchased pre-sale properties that the value hasn't increased or they didn't expect to keep the properties and now they need to close on them. Private lenders can be a great opportunity for someone to leverage the equity that they have in their home and the new property to make sure to close on that property and hold on to it for a period of time while making a decision as to whether or not to sell the property, rent it out, or keep it. Other trends that we've actually seen are second position mortgages to reduce cash expenses and open up cash flow for borrowers. In many circumstances, borrowers have got themselves into hot water, whether because of their choice or something else over the last couple of years. And with the increase in interest rates, it's really squeezed a lot of families. A second mortgage can allow someone to use the equity that they've seen grow in their existing property, reduce expensive credit cards, unregulated car loans, and many other high interest expenses to allow them to essentially hit a reset button until they're in a position where they can restructure the loan or interest rates go down and they can refinance to a conventional lending institution as well. So the thing is, most private lenders are not hoping to be a long-term solution, and they always want to understand what is the exit plan when considering options. The interesting thing about private lending as a whole is that it is considered quote unquote unregulated, but it is becoming more and more regulated as the government adds more and more regulatory changes. What a borrower needs to look out for when it comes to private lending is a few things. Number one, who is providing the loan? Does this mortgage professional have experience with private lending and a clear understanding as to why they chose this private lender over another one? Number two, costs and fees. Typically, a borrower will pay the legal fees for both sides, and they will pay a fee often to the lender and to the broker. But are those fees commiserate to the actual work that was being done? What is the amount they're being charged? And did the broker actually shop around to make sure that this was the best option, including both fees in place? These are okay questions for a borrower to ask, and as long as a fair and satisfactory answer has been provided, then the borrower can continue to go forward and of course arrange that type of loan. Now, in conclusion, we think that private lending has a great place to play in the overall lending landscape. We've seen people close on them both from a high income, low income, and in an emergency case bracket, and it has definitely served our clients very well as long as they're property qualified and all other options are considered. If you're a borrower considering private lending in today's landscape, as we mentioned before, make sure to ask good questions, make sure that it makes sense for your financial situation, and always ensure to understand what is your exit plan.